What matters more here?
I mean, the whole story is about gross margins. I mean, that's really been the headwind on Tesla stock. I'd say $30 to $40 of a headwind to the stock. You saw gross margins. I mean, this is a blowout. Not even us thought that we could see a gross margin, what essentially is anywhere from a 200 to 300 bit beat. This shows price cuts now under control. Margins start to tick back up. You start to get now toward 20% gross margins. I think this is the start of the stock ultimately. This will have a 3 in front of it as a stock as the gross margins start to trend up, and as well as growth into next year from a delivery perspective.
Coming up today, Tesla smashes earnings expectation. I take a look at all the numbers. Are we really in for a lost decade? Is Apple in trouble? The latest global macro and all the after hours action in the markets is going to be a good one, guys. Let's go. And welcome back, everybody, to the Click Capital Daily Market Review. And so it looks like what I forecasted for Tesla's earnings this week turned out to be correct. We did come in with a really good beat, 72 cents per share versus 59 expected, increase in margins, energy business on fire, along with a few other good things as well. And the market's loving it. Currently up 9.2% after hours as I speak. Like I said yesterday, I thought we may gap up 10% or so. We'll see whether we can hold on to these gains as we make our way through the earnings call, but so far so good. And just looking at some headlines coming through now as I speak. Tesla pins 8% sales jump on deliveries, full self-driving, high revenue recognition from FSD. Tesla snaps streak of profit misses with the biggest beat in more than 2 years. They just beat Q3 by 22% above Wall Street expectations. Said their promises slight growth in sales this year, which I consider a remarkable result considering the flood of competition, high interest rate environment, the fact they've been able to expand their margins, come through with a big profit beat when interest rates have only started coming down, I think is a great result. Already reporting that the Cybertruck was profitable, another amazing feat. Did see a slight decline in gross margin, but less than revenue. And like I've been saying of late, their energy business is on fire. Revenue for the unit was up 52% from a year earlier to $2.3 billion. A lot of people still think Tesla is just an EV company, not realizing they've got a rapidly growing energy business. License out their recharging stations to pretty much the whole industry. Probably going to do the same with FSD. They're also planning to mass produce robots. Still telling us we should get a more affordable, cheaper Tesla model next year, the Model 2, on deck for 2025. Still getting a lot of regulatory credits, which are very controversial, often pointed out by the bears as the only reason why Tesla's succeeded is because of regulatory credits, like no other company ever gets them. However, that's the game, they play it well, and we're still getting more and more details come in as I make this video. But like I've been saying, their energy business is a big part of the future for Tesla, and it's already growing leaps and bounds now. Their storage deployments more than double year over year. Governments and big companies all around the world getting these big Tesla battery storage packs, one of the best in the world for storing energy. And just looking at a post Tesla themselves just shared over on X, produced their 7 millionth vehicle at the Fremont factory. Record gross margin for Tesla Energy. Unbelievable, they're already positive gross margin on Cybertruck. Giga Shanghai produced its 3 millionth car and exported its 1 millionth car. As of Q3, the Model Y is the best-selling vehicle of any type in 2024 in Sweden, Netherlands, Denmark, and Switzerland. They're building out huge compute power, already training on a 29,000 H100 cluster at Giga Texas. Expecting to have 50,000 H100 capacity by end of October. That's NVIDIA GPU chips, building out these massive chip farms so they can run torrents of data through. And so once again, they continue to prove the skeptics and bears wrong. Even though they have had a few soft quarters of late, the greatest businesses in the world never just grow every single quarter for the life of the business. And I believe the future is even more exciting for Tesla. I think its best days lie ahead of it. And that's why I continue to be a long-term believer and bull. And I plan on being a part owner of this business for the rest of my life. Net income was $2.2 billion for the July to September period, up 17% over the same quarter last year. $25.2 billion in revenue for the quarter, up 8% from a year earlier. They're tracking on an annualized rate of over $100 billion. And this has been a tough environment for EVs the last couple of years. And so that's the thing with modern day market. Companies have a few soft quarters, stock gets smashed down 40, 50%. Everyone says it's over, et cetera, et cetera. However, you just step back and look at the big picture. What you're looking at here is the income statement for Tesla over the last 10 years. Looking at TTM, trailing 12-month revenue. 10 years ago, $3.2 billion. Here we are today, $95 billion. And they just did $25 billion in Q3 reported today. Huge explosive growth. I mean, it was only 5 years ago they were doing 24.5 billion. They've quadrupled that. And like Elon says, potentially robotics will be the biggest business for Tesla in the coming years. Of course, it's still early days there. However, it should keep a tailwind and valuation for Tesla going forward. And for the here and now, the market is certainly liking this result. And just going out to the daily chart, we did sell off a little bit in the regular session coming into this. That was the gap down after they presented Robotaxi on the Optimus bots. So we're currently trading after hours around 233, just below the 50-day VWAP here. See if that can hold on to overnight gains. And like I'd been thinking all week and telling you guys, had a feeling they were going to beat. We may gap up 230, 240. And so far, it looks like we're tracking in line with that forecast as well. And stick with me today because we'll come back to Tesla stock price later and we'll see whether these gains can hold up going into the after hours session here. But first, let's talk about a bit of a popular topic this week across the financial news and community out there that's got people talking. Goldman Sachs came out over the weekend, said the S&P 500's golden decade of returns is over and that we would see annualized returns of 3% over the next 10 years. And that would be down from the 13% annualized figure from the prior decade. And whilst that certainly could happen, I think people get overly obsessed with just focusing on the S&P 500 index all day. There is an entire world of different markets out there, not just the S&P 500. But anyway, let's just take a little bit of a deeper look at this. And I'm going to propose a little bit of a different theory to kind of counteract this and maybe why it might not pan out as is widely believed. So no doubt there's good arguments to be made. At least technically speaking, the S&P 500 is stretched. And looking back in prior history and valuation, we are near record level. However, this is something we've been hearing for a long time. Their forecasts before have fallen well short of reality over the last 20 years. And I agree with Ed Yardeni, who's arguing for high returns due to productivity growth and strong tech fundamentals. And especially his point that it's hard to imagine the total return of the S&P 500 would be only 3% in the future, given the returns just from compounding of reinvested dividends, which is true. A lot of people get obsessed with the price index instead of looking at total return, which is when you reinvest dividends, you get that compounding effect. But also keep in mind, the S&P 500 is only going to make 3% annualized over the next 10 years. Research piece from Goldman is just that, one research piece from one person. And that came out from the same Goldman Sachs who just published last month. AI stocks aren't in a bubble. Once again, making a detailed, logical, factual-based argument as to why AI is not a bubble. And in fact, if you look at their wealth management business, asset management, they are significantly invested in AI, as are their clients, some of the wealthiest people in the world. So just because we get this one headline that one research analyst from Goldman has come out with this prediction on the S&P 500 doesn't mean that's the entire position from the whole investment bank, as is what's known in investment banks as Chinese walls. And that is information from one department, say research, advice. Sell side is not supposed to be shared or mixed with the buy side, the traders, the investment managers. And so my point is, don't be fooled. Goldman Sachs are heavily invested in the AI boom. And like I said, they put out this piece last month on their website that their clients read, AI stocks aren't in a bubble. And now over to my theory on valuations, for which they base their forecasts, and so do a lot of other people as well. And just a warning, if you're a perma bear, this is likely going to trigger you. So viewer discretion is advised, and you may want to sit down for this one. So here we are looking at the Shiller PE ratio, also known as the CAPE. It's basically just taking current valuation of the market, dividing it by the last 10 years earnings. Very similar to market cap to GDP, which just gives you a broad, blunt, general measure of valuation of stock relative to earnings and then adjusted for inflation over time. So what we hear a lot from the bears is the long-term average on the CAPE ratio, Shiller PE, market cap to GDP or whatever is way lower, which is true. The Shiller PE ratio long-term average is about 16.5. You can see we're significantly above that, more than double. It's what makes the bears so angry. Can't imagine hating a bull market, but anyway, so be it. However, I think a long-term simple average is just that, a bit of a simple approach, a simple statistic, kind of a layman's way of thinking about it, which doesn't take into account huge changes we've seen in financial markets over that time. And so if you really want to model data, instead of using a simple average, what you want to use is a linear regression. And so you could think of a linear regression as kind of a best fit to represent the data and the overall trend, because like in many data sets, we do see trends. And so if you were to apply a linear regression to long-term US stock market valuations, it would actually look something similar to this. And if that's the case, then even though we're a little stretched here in the short term, looking at a long-term trend, we may not be as exorbitantly overvalued in a crazy bubble as pretty much everyone online will tell you. Because a lot of people say, because the Shiller PE's at 37, so far above the long-term average of 16. Just because of that reason only, it has to come down. Because the last time we got there in the 90s and in the 1920s, it came down, so therefore it should again as well. All the fundamentals, AI, fourth industrial revolution, that all sounds great, but that doesn't matter. It's just a big number, therefore it should come down. However, like I said, there's been major progress and evolutions in financial markets since the 1800s and even early in the 20th century as well. Number one, financial markets were so much more risky back then. Trading was done on an exchange, typically only for the very wealthy. There was way more wars. Markets were hugely volatile. You think we get volatile today. You study your history, see the volatility in stocks and interest rates back then. And that's another big reason. Interest rates have come down over the last 200-300 years as well. And another structural secular trend. And so the lower interest rates are, the more premium valuation stocks should be. Also increased access to the stock market, not just from everybody domestically. Now anybody around the world can invest in US stocks with a click of a button. Technology gains, institutional investing, retirement accounts coming in a big way, investing every day. And ever since the late 80s, the Fed put all that fake artificial liquidity, America dominating technology, being able to distribute products and services around the world in a way they simply couldn't do 100 years ago. More economic and social stability. And so for all of these things, I believe valuations deserve to be higher than 20, 50, and 100 years ago, and that we're in a structural uptrend in valuations. As you can see on this chart here with high highs and high lows. And like I said, investing back here was very risky. You'd need a huge premium to compensate for that risk, not to mention way higher interest rate, which we can see in this chart here that I've showed on this channel before. Looking at that annual real rate trend, it's down almost 2% per annum. Looking at nominal loan rates and the resulting real rate. Over time, markets become more efficient, the cost to borrow comes down, increased access, and basically humans just get better at what we do, running economies and financial markets. So when people say because it's 37, it has to go back down to 16 like it has before in history, they're completely discounting all of those things I just said. They're just saying it's a big number, it has to come down. That's the whole basis. Like I said, bit of a layman's approach, and it's not really even modeling this data correctly. And so maybe a new long-term average going forward, the next 10, 20 years for the Schiller PE could be somewhere around 27, 28, especially if interest rates stay low. I think the only thing that could really upset this is if we got rates like we did back in the 70s, 10, 15%. However, the US government simply can't afford interest rates to go to 10, 15%. They have to keep them low. That's why I'm a big believer in inflation coming back and positioned long in commodities. So whilst I'm not saying this definitely can't happen again, that would be to what's known as a prediction, when you're forecasting something with 100% certainty, but none of us know for certain what's going to happen in the future. However, my forecast is that we're going to revert back to a more higher for longer long-term average if we don't see interest rates go back to crazy levels above 10, 15%. I don't think modern day economies, at least here in the West, could simply handle that. That's why I think central banks have chosen inflation. And who knows, maybe we do get a recession in the next couple of years to help bring inflation down. However, that will keep interest rates low, which should help keep valuations propped up as well, even though, like most recessions, the stock market will pull back for a year or two. Most bear markets only average about a year and a half, but people spend most of their time and lives focusing on that for some reason. And like I said, there's more opportunities out there than just the S&P 500 index. When people say the market's overvalued, crazy, I always say, what market exactly are you talking about? Because even when looking at the S&P 500 itself, looking at the equal weighted S&P, its price to free cash flow currently 26.3, which is pretty much a similar level it's been over the past decade. And of course, the cap weighted is a bit stretched there thanks to mega cap tech. However, their earnings are growing like crazy as we move more and more into a digital era for which they dominate around the world. So those high valuations could actually be justified. And there are some positive signs out there, some green shoots that we could potentially still be an early business cycle. Mergers and acquisitions starting to tick higher this last quarter. Seen initial public offerings, private companies going public, also starting to uptick these last couple of quarters. That's a good sign. Fresh equity coming to the market, still well off those early 2021 highs. And what you really want to see in a healthy bull market is both earnings and multiple expansion. Here in the purple, price to earnings year-over-year growth. In the orange, earnings per share. So you can see after COVID, it's actually earnings pulling back. It was a massive liquidity injection, and so it was valuations expanding. Basically, investors getting more excited about owning stocks. That drove that rally. Whereas in 2016 into 2018, investors were getting less excited about owning stocks. However, earnings were still growing really well. Good news is this time we've got both. We've got multiple expansion and earnings ticking higher and broadening with still plenty of room to run. And just looking at the Nifty 50, the top 50 market share of the S&P 500 in the last 12 months, price to earnings. There's the gray there, 30.5. The bottom 450, 24.4. And just looking at the premium discount from the top 50 to the bottom 450, well off the peaks from the late 90s, even the mid 1970s as well. And that's a difference between the late 90s. some tech stocks just went absolutely crazy, talking about PEs 200, 300. Some of the biggest stocks weren't even profitable, and the market just got well carried away. However, you could think of it like America's been in a secular tech boom. I mean, you could say 30 years going back to the mid-90s. Or you could even say the late 70s since the NASDAQ came on board, and maybe the internet was just a warm-up for what we're in now. I'd agree with some of the smartest people in the world who say AI is more consequential than the internet, and everything it's unlocking, pretty much touching every industry. You could pretty much think of it as taking the internet and digital communications to a whole new level, where computers can start running themselves and making their own decisions. Instead of us telling them when ABC happens, do XYZ, now the computer can determine what is the best thing to do. That's AI. And so on top of the potential of us being early in a fourth industrial revolution led by AI, this also comes at a time when the Fed has absolutely blown out their balance sheet and the currency in circulation. Ever since COVID, like I said, just an explosion of liquidity and currency in the system that isn't just simply going to correct itself overnight. Like I said, it could take 10, 20 years for this to normalize. Another reason markets and valuations are likely to stay higher for longer. Whilst your favorite furus out there keep you spooked out of the market, it's no wonder there's so many people on the sidelines and scared to invest when they don't realize they're actually short inflation and could be potentially missing out on one of the most exciting decades of our lives. And it's not just America either. We've got global M2 money supply increasing again. China starting to open the floodgates, copy the Americans, directly intervene in markets, start propping them up. They're about to flood their system with liquidity. They've already started loosening monetary conditions and liquidity over there, with more to come. And at the end of the day, if you're a perma bear, or even if you're out of the market, this is pretty much the chart that you're short. US large company stock returns, log scale, over the last 200 years. Pretty lucky to time one of these tops. However, after you've been in the market for a while, you realize that's pretty much impossible, and you kind of move out of that trading mindset to a more ownership accumulation mindset. Warren Buffett didn't get rich by trying to time the top. He got rich by accumulating quality stocks he knows and understands at a fair price. But just moving on today, and to balance out all those bullish arguments with some bearish news, we got Apple falling a bit here today after an analyst says iPhone 16 orders cut by 10 million units. So he sees no evidence AI boosting demand, and that Apple's AI features are not yet driving immediate iPhone upgrade. And so the jury's still out on whether Apple's going to live up to their rosy expectations. They can get back to growth on the back of a new upgrade cycle. What's the market really think about the iPhone 16? I've had a chance to play around with it, and I mean, it's not really mind-blowing. It's just another upgrade. Camera is nice, a few little bells and whistles. But like I said, Apple doesn't really innovate. They've used all their cash just to buy back stock. They pretty much just take existing technology and integrate it into a device, slap their logo on it, charge a premium, and they've got so much brand strength. Most consumers don't even know any different, and they'll buy it anyway. But nonetheless, they are still the number one brand in the world by a lot of measures. And if they can just eke out a little bit of growth, they could be able to hold on to their lofty PE, currently still above 35. Remember, their revenue's been flatlining for a few years, so they really need to come in with a good quarter here next Thursday when we hear from them. Investors will be looking, how's their iPhone 16 going? They meeting expectations? What's their forward guidance? Any issues with production? Because it seems like investors are still on edge here a little bit with Apple. And like I reported on yesterday, as it was happening, when news hit the wires, McDonald's fell sharply after the CDC ties quarter pounder to an outbreak of E. coli. And again, just kind of curious timing, isn't it? Political frontrunner for this election did a big campaign event at McDonald's over the weekend, and just so happened a few days later, we're getting news spread all across the wires that's spooking investors, sending their stock lower and likely harming their reputation and potentially affecting sales for this quarter as well, almost like they've been punished. Now, of course, that's just a little bit of an entertaining theory getting around social media. Not sure whether I believe that or not. However, it could be a coincidence just a few days later that this happened. Nonetheless, investors look like they bought the dips, going down to a 5-minute chart here. Straight off the open, investors got right up in there and defended that open price for the rest of the day as well. And I got another one for the bears. Boeing, continually in trouble. Can't seem to get it right these last couple of years. Boeing-made satellite exploded in orbit. Now there's space junk everywhere. Apparently there's roughly 3,000 dead satellites littered across space, with 34,000 pieces of large space junk and millions of smaller pieces. And this is just after news we got last month. SpaceX having to rescue stranded Boeing Starliner astronauts, which is still going to take another 5 months to bring the pair home. Not to mention their accident record over the last couple of years as well. That's why Boeing stock, one of the most volatile blue chips out there, and And just looking at a monthly chart here, it's pretty much been a lost decade for Boeing. And I know they're a great long-standing brand, but as an investor, this doesn't really interest me at all. Just so much issues here. I mean, how do you analyze this stock? It's almost impossible if you ask me. Now onto another stock I've been covering of late, Tiger Brokers, also known as Up Fintech. And first, just before I get into this, as a quick reminder, any stocks or positions that I'm in that I mention on these videos is not investment advice. So please always do your own research, trade at your own risk, as this is not a swing trade for me. I'm a long-term investor with a high tolerance to volatility, and that style may not suit others. So again, whether this is bearish or bullish can kind of depend on your time frame. Short-term day traders, they hate seeing news of this. Public offering, secondaries, companies selling more shares to the market, raising money. That's what we just got news of last night from Up Fintech, in which they announced the pricing of 15 million American depository shares at a price of $6.25 each. The company expects to use net proceeds of approximately 90 million for strengthening the company's capital base. So this is not like a typical company that does a secondary small crap penny stocks because they're burning cash. They need to keep selling shares just to kick the can down the road, keep the lights on, and that's typically really bad for the stock price when they do that continually, especially if they're burning through cash. It's just a recipe for short sellers to jump on them and knock the price down further. Our investor, who I've read about a lot and respect, Peter Lynch, he taught us never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. That's very true. And so just looking at Tiger Brokers' latest quarter, we got about a month and a half ago, and this was before the huge rip in Chinese shares, for which they offer direct access to traders not only in Southeast Asia but also around the world. Trading volumes increased 23% quarter over quarter, 62% year over year, 105 billion. Second quarter revenue, all-time high. They also added 48,900 new funded accounts, bringing the total number of funded accounts to almost 1 million, 16.8% increase compared to same quarter last year. I'll be really excited to see their next quarter's numbers as well after the huge rip in Chinese shares. Total revenue is up 32% and they are profitable. Net income was lower compared to the same quarter last year due to a one-off item. But what's really exciting is that even though they have almost 1 million funded accounts, they actually have over 2.3 million actual accounts. So a lot of customers may come back and redeposit in their account, start trading again, especially because they can get access to trade Hong Kong shares and shares over on the mainland, listed in Shanghai and Shenzhen. Now just over to their balance sheet. Total assets, 3.7 billion. Total liabilities, 3.2 billion. Total equity, almost $500 million. And so they've got a pretty strong and healthy balance sheet, liquidity. They're profitable, not really burning through cash. And so I know when people see secondary offerings, they freak out, especially day traders. That's because it's usually small penny stocks doing that because they have to replenish their balance sheet, keep them going. So of course, I'm not saying Tiger Brokers is not without its risks. Like I said, these are not your grandma's bonds. So Chinese related stocks are going to move around a little bit. A lot of people don't realize how volatile Chinese related shares can get. And so no doubt we've seen a big pullback here. I actually bought some more shares today myself. Again, that's not financial advice. I just occasionally share with you guys some positions I'm in. But like I said, this is not a swing trade for me. I plan on holding this for at least several more years. If the business still holds up, revenue keeps growing, they don't have any massive problems, and I, along with nobody else, can predict that with 100% certainty. That's just my forecast and how I'm positioned. And this is just one of many positions for me. I don't have my whole portfolio in it or anything close to that. And so that's pretty much where I am with Tiger Brokers. And it's pretty much just been pulling back with the overall China market as well. Got a bit too excited ahead of itself there. I think the Chinese authorities didn't like what they were seeing. Things were getting too carried away. All of us Westerners were front running their big stimulus. They threw some cold water on it and they're still being stringing out bit by bit, but we're still yet to get the big, massive bazooka fiscal package. But my bull thesis on China is not all depending on this big fiscal bazooka package. I was already bullish China since late last year on valuation reasons, just how big a divergence there is between their economy and capital markets. And like I said, I first started talking about Tiger Brokers earlier this year when it was in the low threes. And so for sure, this is really volatile stock and is likely to be probably for many more years ahead. Just moving on to the macro, we've still got bond yields trading firm, moving up here, with some still scratching their heads as to why they're moving higher. In my opinion, I think they're pricing in a new government and the potential for the US economy to perform better than expected, GDP to hold up next year, along with some tailwinds for inflation. The risks could be flipping back to the upside instead of the downside that everyone was convinced about a month ago when the Fed cut 50 basis points. Once again, markets do a pretty good job at flipping the narrative, and we're in a global easing cycle. Saw that again today with the Bank of Canada cutting their interest rate by 50 basis points, now getting it down to 3.75 after they'd already made a string of smaller cuts. Pretty much the same story around the world. Inflation's come down and central banks are bringing their interest rates down. May have just got out in front of a recession. However, that's still yet to be seen, but they could actually be pouring more fuel on the fire of inflation. But a big part of that will be oil. If oil can continue staying down in the low 70s, even getting into the 60s, that'll help inflation a lot. However, if it were to go back up above 80, it's kind of almost impossible that we won't get an uptick in inflation. And there's a look at it today, just hovering around $71 a barrel. Well, we got a little bit of a pullback in gold there today, as we did in silver. A lot of markets took a little bit of a breather there today. BRICS still continuing the summit. We just heard from Xi Jinping calling for an end to the Russia and Ukraine war, maybe potentially setting the stage for some negotiations to take place in the coming months. Also interesting to note, the S&P 500 and gold are both having their best year-to-date performance ever. And funny enough, both in tandem with each other. Gold now up about 33% year-to-date, best performance. And like I said, we could be in for a bit of a short-term pullback consolidation, as it is quickly becoming a bit of a consensus trade out there. And just getting back into the charts. Oh, look at that on Tesla, continuing to rip as I speak. Now up 11.6% after hours, 238. I was thinking we might get around 240, see whether these levels hold. But at this stage, looking like Tesla's going to gap up tomorrow on this really good earnings report. And just looking at what else is moving out there today, still got quite a bit of volume on the smaller end of town. Some of these biotechs still ripping. Tivogen up 54% today. Another one, SGMO, ripping up 27% today. And more industrial companies expected to benefit from a potential boom in US manufacturing and reshoring of production. Belmont Industries trading up really good on earnings, as did Packaging Corporation of America. Very similar charts. A lot of industrials, old school domestic stocks looking like this now. And some other stocks as well in play. Funware slapping on another 21% today on heavy volume, along with some other formerly beaten down high flyers. Peloton ripping up over 10% today. What's also been doing well of late, inflation ETFs that hold stocks that could benefit from a return of inflation. INFL, another one, Fidelity, stocks for inflation ETF. Look at that, pretty persistent uptrend, isn't it? Getting quite a bit of volatility in the bond market of late. There's the MOVE index, the VIX for the bond market, trading up multi-month highs here, 129, while option dealers are still pricing in potential rug pull of a day around the corner, which even though the S&P 500 finished down almost 1% today, mega cap tech as a group down 2%, NASDAQ down 1.5%. Just looking at the sectors here, we still had some actually finish pretty much flat, like regional banks, aerospace and defense actually up a little bit, utilities and REITs actually up a little bit less than 1%. Tells me that's a rotation. Wasn't a complete sweeping sell-off, bearish breadth of a day. Means we've still got a rotation going on. And we can see that looking at my sector breadth table. Actually got REITs and utilities popping up in the front here, and financials still strong in the short term as well. When you see all this go completely red, that's bearish breadth, indiscriminate selling across the board. What we're seeing here is a continued rotation, and that's a sign of a bull market. And that's not to say we can't get that complete bearish breadth of a day. Like I've been saying, it's too good of an opportunity for the market to pass up, as it'll flush out so many weak hands right in front of the election, possibly in tandem with a bad headline, something surprising us, maybe Iran attacking Israel back or something like that, enough to spook the market, get some bad headlines out there, and we could get that big bearish breadth of a day, down 2-3%, maybe a bit of follow through the next day or two. It'll be a good flush out, and I think that'll be a buy the dip opportunity. And I think that could happen for the 5th of November, potentially. And then that would prove the option dealers right, which they mostly are most of the time, and they can readjust all their books, and we'll probably see a dive in the volatility risk premium with that. Other than that, that's pretty much a wrap for today, guys. Thanks very much for tuning into the Click Capital Daily Market Review. And just quickly before you go, I'm interested to get your feedback on a simple survey. And in exchange for 5 to 10 minutes of your time, fill out this survey. I'd like to give you a report that I just made, the top 10 stocks to watch in 2025. Now, these are exciting, small cap growth stocks, some of the hottest stocks I've got on my watch list that I'll be talking about here on the channel over the coming weeks and months. I'm actually already invested in one of them, and this is just a preview of the first stock that I profiled, Rocket Lab. And under each stock, I list the secular trend that it's set to benefit from, and I give you my thoughts on what makes each stock unique, along with my bullish thesis on them. And so if you'd like to get instant access to this report, then just click the link below this video, head on over to clickcapital.io/survey. The survey is completely anonymous. You don't have to enter your name, email, or anything else. It should only take 5 to 10 minutes. And I'm basically just interested to find out more about you and what you're interested in and how I can make the daily market review better for you guys. So it should only take a couple of minutes of your time. And so a huge thanks to anybody who fills out this survey and then gets my report. I think you'll really enjoy that. That's all for today, guys. And I look forward to breaking it all down again for you this time tomorrow. Cheers.